Welcome to Earnings IQ. My name is Kyle and I will go over the basics behind stock options. So what is an option? It is basically your ability to buy time. It is essentially a contract between a buyer and a seller. As an example, let's say that you buy a contract today for $1 where you have the option to buy the stock at $10 between now and 10 days from now. The stock price now is $5. But it is trending upwards, and by the end of the 10-day period, the price would be about $19. In essence, if you exercise the right to buy the stock for $10 on day 10, then you could sell the stock for $19. So you have a profit of $9. The concepts behind the out of money, at the money, and in the money are evident in this chart. You can see that when the stock price it's beneath the exercise price of $10 that you bought the option for, the call option in this case, and we'll explain that later in terms of what type of option contracts do we have. In this scenario, you're out of money, meaning that you'd not exercise the option you have because essentially what you'd buy the stock for it's higher than the market value of the stock. At $10, you are right at the money, meaning that it's the same, it's equivalent of the same because you could either exercise or buy it at the market price. And then in the money, it's when your stock price or the exercise price is lower than what the current value of the stock is in the market. With that said, we'll move on to the next slide. So in terms of basics, I mean, in every contract you have a buyer and a seller. So the option buyer is the individual who owns the rights to the contract. The seller, they have to abide by that contract within the specified time. So in the example we threw in earlier, within 10 days, the buyer has the right to buy a stock at a predetermined price, and the seller has the obligation to sell that stock at that predetermined price. And depending on where the price of the stock goes, the contract could be exercised or not, but that's more on the buyer's side, meaning that they own the contract and they can elect to exercise it. And evidently, they would not exercise it prior to the contract being in the money, as explained earlier. Some of the basics behind the contracts are the buyer owns the contract, they own the rights to the contract, they are referred to as a holder, and then in an example of a call option, which is the option to purchase that we explained earlier in the previous slide, the buyer is referred to as holding a long position because they expect that stock price to go up, so that is where they are expecting to make the cash. And then the last thing, it's at expiration, the holder will exercise the contract if it has value, but they can let it expire if the contract has no value. Your counterparty to a transaction, in essence, it's not actually the seller, but it's the option clearing corporation, which essentially matches the sellers with the buyers. So although the seller has an obligation, most likely that's not a one-to-one, and we'll explain that in one of the upcoming lessons. But the seller, as we said earlier, has the obligation to honor the contract. They are the creator of the contract because they do get the premium of, or the option price that the proceeds of the option price go to the seller. Under a call option, a seller's position is referred to as a short position because they don't anticipate the stock to go up, they anticipate the stock to go down, in which case they retain the proceeds from the contract sale. And again, the opposite of the buyer, under 3, the seller, if it's still holding the position, might be asked to honor the position if the contract has value to the buyer. With that said, we'll move on to the next slide. So we mentioned earlier there are 2 types of basic contracts, the calls and puts. The call is an option to purchase, and then the put is an option to sell. So you can buy a call option for, let's say, Spirit Airlines, which let's say has a price of $10, but you buy a call option to buy the stock at $11 per share between now and 10 days from now. So that is a call option. On the opposite side, you can actually buy a put option contract, in which case, let's say the strike price is $9, and you have the option to sell that contract for $9 between now and 10 days from now. Once you have an account and you're able to start trading, you'll see that the transaction types are the basic transaction types are included in 4 categories, and then we'll move into the different legs and and spreads and so forth. But so this slide here tries to show where the buyer is sitting and then when the seller is sitting. So when you buy to open a contract, let's say you're buying to open a call option, in that scenario, you'll have the ability to buy to open that, or you will go through and buy to open a contract. And in this case, the seller will sell to open. The seller is the originator of the contract, so they start, like, they open up the contract, but then they will have the obligation to honor that contract if that contract is fulfilled by a buyer buying to open. And then on the opposite side, then the buyer can close a contract and before it expires. So that's the difference between a U.S. contract and let's say a European contract, which you have to hold it till the end. But under the U.S. options contracts, you can sell it at any time between now and the expiration date. And in this scenario, the buyer has the ability to sell to close. The seller on the other side can buy to close, right? So it's going the opposite way from what they have. So there's always a market between these four categories. From a seller's perspective, you sell to open when you open up a contract, but let's say you don't want to hold that and risk the scenario where you were obliged to not necessarily exercise but to honor that contract. So under a call option, the buyer can, or the option clearing corporation will force you to honor that contract and provide the stocks that, if it's not a covered call, for example, and we'll explain that later, the seller did not have the stock in the first place, so they have to go to buy it in the market and then provide that stock to the buyer and so forth. So if you don't want to hold it till the end, then you can buy to close. So you buy the same number of contracts and you can close what you had to sell to open. We'll go into more detail as we go through the lessons here, but these are the four categories. Again, you have to buy to open, sell to close under the buyer's side, and then the contract seller has two options: a sell to open and buy to close. And what's open interest and volume? Well, I mean, the number of contracts that are traded daily, that constitutes the volume. So in here, the category in the middle, like within this bridge, it's what represents the volume. So we have 30 items that have been traded. So you have 10, 10, and then a negative 10. I'll explain what the negative 10 means. But if you're trying to figure out what the open interest is between the start of the day and the end of the day, then the number of transactions that occurred within that day doesn't necessarily equate to an increase or decrease to like a one-to-one increase-decrease in the open interest. Open interest is the number of contracts which are still out there outstanding and they have not been exercised and still being traded. So in this case, let's say at the beginning of the day, there are 100 contracts out there, and then trader A buys to open with trader B, and in this scenario, you'll have 10 contracts. And then in the middle, we have trader C, which buys to open with trader D. So we have another 10, so 20 transactions. Then trader B, which was the seller, doesn't want to keep that contract that they had. So what they do is they buy to close with trader E, which is another trader. So in this scenario, that's a transaction. So there are 30 items or 30 transactions here, but there's only the volume only changed by 10 because the first transaction, which is trader A buys to open, it's canceled with trader B buys to close with trader E. So in this scenario, the open interest volume goes from 100 to 110. So this is good to know because at any point in time, if you want to see how many open interest contracts are out there, and if they side or they weigh more on the call side. So if I'm looking at, let's say, Spirit Airline, and I can see how many open interests are out there, and I can also see the split, the weight between, let's say, 80% are call options versus 20% which are put options out of the entire open interest balance. And I can also see, kind of track what the volume is, and then kind of look at what was bought to close and so forth. That gets a little bit more complicated, but as we go through and move on into the next lessons, you'll see what I mean by that. An option chain, it's essentially, I mean, once you have an account, you can see all the details behind it in terms of when the contracts will expire, what's the strike price, the underlying, in this case, the underlying stock, and so forth. There are also the Greeks. The Greeks are essentially the indicators behind the stock option. So there's a calculation between stock option, which is based on the Black-Scholes calculation. It's a little bit different in the U.S. versus Europe, but the different elements behind that feed into the calculation of the option price, those are also tracked to a certain degree, like the slope of the change and so forth. So delta, for an example, it's the change in the option price for $1 change in the underlying stock change. So if the stock goes from $10 to 11, what's my option premium going to be? Like what we will change by? Like if at $10 it was selling at 1 and the delta is 10 or 10%, however you want to look at it, then a $1 change in the stock price going from 10 to 11 will lead to a 10-cent increase or 10%. But it's easier to look at it in cents actually. So 10-cent increase in the option premium. So it's going to go from $1 to 110 and so forth under a call option. So we'll go into details. It's easier to look at examples, but I think this gives you like a quick overview of what an option contract is. The different scenarios in terms of we have a call option and a put option. How can you trade those, and what are the 4 transaction types and how they are correlated with each other. With that said, please feel free to subscribe to my channel here, and I'll see you next round under lesson 2, where we'll go through details as far as the Greeks. We'll start with delta and moving to the variability and so forth, time decay, etc. Thank you.